Greetings and Happy New Year's, beloved clients and friends. Coming to you live from Logging Camp Meadow on New Year's, actually it's January 2nd. So I want to I'm going to try to talk loud so you could hear me over the crunching of the snow underneath my boot. And so I want to talk about 2021 review and 2022 outlook. Okay, so 2021 was actually a pretty good year for the financial markets. I think our core portfolio was up north of 30%, a little bit better than the S&P and the NASDAQ. Actually, this year the S&P outperformed the NASDAQ, which was a first in a while. And and it was the third year of really good returns. 2019 was really good for our investors. 2020 was excellent, and 2021 was also pretty good. Towards the end of 21, we started giving back some gains, but the big contributors to our gains in 21 were, of course, GameStop at the beginning of the year. Tesla was another big winner. Google, Costco, Microsoft, and also Bitcoin. We bought that early enough that, although very volatile, overall it did well for our investors. So, so in 2021, the market started out really hot, and about March, the growthiest sector of the market really kind of peaked. The really speculative high growth stocks really kind of peaked and started giving back, and then the next level growth stocks started giving back around in November. And so we had some success with those type of companies in especially in 2020. So some of them we held too long, and unfortunately some of those we did hold too long, but we started to shift the portfolio away from that type of company to more established, stable names. We added, like I said, we added to Google, Costco, and we bought a company called Invitation Homes because I like real estate right now, and they own single family residences. We bought a company called Steel Dynamics, which is a steel manufacturer. So more traditional type of companies. Regeneron, which is a biotech company. And at the end of the year, we bought AT&T, and I think we're going to probably buy some more, because that's one company that has not really participated in the run-up the last few years. And their revenue looks great. Their balance sheet looks great. Their dividend is like north of 8% right now. And so they look like a good company that's kind of cheap. I think we might go back into Berkshire Hathaway as well, because Warren Buffett did really good in the type of markets that I think we're going to be in 2022. Okay, so here's what I see, what we're thinking about for 2022. It looks like the Fed is going to start raising interest rates. Okay, and a couple months back, I did a video called Clouds on the Horizon, and one of those clouds appears to be materializing, and that is inflation. I'm concerned about inflation, and sure enough, inflation numbers came in red hot, like north of 6%, and Powell said, hey, I think it's time we take the word transitory out of our vocabulary, meaning I believe inflation is here to stay, not just transitory. And so that means he's going to start reacting. He's going to start changing his stance from very accommodative, really buying a lot of bonds, meaning pushing a lot of cash into the economy and slowing down that quantitative easing and even raising rates. Okay, so that's a big change. And that's something that they're just saying you don't want to fight the Fed, don't want to go against the Fed. So if the Fed is pulling in their horns, maybe we should go much more defensive as well. And there's talk that he could be raising rates 3 times in the coming year. And it might be 3.5% raises instead of 3/4% raises. So we believe that interest rates in 2022 could go up anywhere from 0.5% to 1.5%. Okay, which is a lot. And if we look at history, this is, I think, we could look to 1994 as a guide as to what could happen if rates raise. Because in 1994, Greenspan raised rates 6 times. There were 6/4% raises, and I was early in my career at that time, and I remember the difficult conversations that I had to have with clients in 1994. And so I want to prepare my clients right now that we may have some difficult conversations in 2022. And I just want you to be prepared for that, we're not always going to have years like we had the last 3. And we just kind of got to take them in stride and do our best to be defensive and be forward looking and ride through this. There's the best we could do is navigate through it. And if you've been with me for a while, we navigated through coronavirus. We did pretty well, which was a huge disruption. We had a big pullback in first quarter of 2020, but 2020 turned out to be a phenomenal year. For those of you stuck with me, we were able to ride through it and come out really well on the other end. Fourth quarter 2018 was pretty bad too, but it led to 3 great years, 19, 20, and 21. So, and if you look back at 1994, it was kind of rough for the stock markets and especially for the bond markets. But it paved the way for an incredible run, 95 through 2000. Okay, so keep that in mind. 2022 might not be as fun as 19, 20, and 21, but if the Fed does the right thing and if we do the right thing and position our accounts, it could pave the way for another good run. And it's just kind of one of those things that you gotta grind through it. Okay, so we're making changes. We're going more defensive. I believe we'll be having a big position in AT&T, Berkshire, and in TIPS, which are Treasury Inflation Protection Securities, TIPS, because the rate they pay goes up with inflation. We like those, and we've been in TIPS for a while now, and we want to add to that position. So look for the portfolio to be more defensive and to kind of just grind through this coming year with hopes that we'll be well positioned when we come through this. And I mean, we're going to stay on top of things. And so if you look at big pullbacks historically, and there's kind of 4 that I want to look at to kind of give us some guidance. And so from 70 to 74 was just a rough slough for the equity markets. 2000, 2001, 2002 was another rough slot for the markets. 94 in between that was just kind of a rough year, but it was just a pause in this long secular rise. And then 2008 to 2000, 2007, 2008 was another really rough time in the markets. And so what do I think is in front of us? Like I said, I think it could look like 94 with those a lot of tax increases. I mean, not tax, interest rate increases that could affect especially the bond markets negatively, but also the equity markets, and especially the growth side of the market. But if I think about 70 to 74, it was the end of this 25-year bull run from the end of World War II to 1970. So like a 25-year run where things just were crazy. There was companies they called the Nifty 50, and they're the 50 biggest companies, and you could almost do no wrong with them, right? And they had gotten ridiculously overvalued. As a matter of fact, Warren Buffett decided to retire in '69 because he said, "Man, I don't see that I could do what I do in this kind of market," because he was looking for mispricings and values, and so much of the market was overvalued. And sure enough, there was this long grind where those overvaluations worked themselves out of the market over a long period of time, like 4 years. And the whole decade of the 70s wasn't great. But then it gave way to the 80s and 90s, which were phenomenal. There was really one bad day in there, which was, October 1987, but it was a tremendous 20-year run. And like I said, there was a 94 in there, but it was just a hiccup and a pause in this 20-year run from basically at the end of the 70s, like 80. Well, when Reagan started, there was kind of a pullback, 81, 82, but those 2 decades of just great returns in the markets. And then 2000 came, and it was the same thing. It was this long, slow grind of valuations back down to where they should be in it. And it was really 2000 to 2002, but the whole decade of the 2000s they called it the lost decade. It just wasn't really good for investing in stocks in general. You had those 2 big ones, the 2000 to 2002, and then 2008. And so really, from the start of 2000 to the end of to the the bottom in 2009, the market was essentially flat to down. And then since the beginning of 2009, we've had a really nice 11-year run. And I think we might have a little pause this year, but I don't think that run is over, right? The 45 to 70 was a 25-year run. 80 to 2000 was a 20-year run. And now if we look at 2009 to question mark, I think it's going to be longer than an 11-year run, with maybe a little bit of a pause in between. So that's what I think we're looking at. So don't fret too much if we have a pause in the midst of this long run. What can we do about it? Do we just go to cash? I don't think so. Not when inflation is 6%. Meaning cash is -6. If we try to eke out a low single-digit returns, I would be happy with that in 2022. All things considering, and just position the portfolio coming out, because coming out, I think there's some really exciting things going on. The millennials are doing things differently, and we're talking a lot about that in the office, about what companies are well positioned for the millennials, because there's a 20-year, I think, window when the companies that the millennials like are going to do really good. And let's frame that from what are the companies that have missed the boat on the millennials, or looks like their time has come. And I think the poster child might be Harley Davidson. Boomers loved Harley Davidson, and the stock did really well, but it struggled to delight or be the darling of the millennials. So that's the type of thing we want to stay away from. Malls in general are not a millennial thing, right? They shop online, and anything mall related, all those mall companies. And then one type of company that did really well in the previous generation that I don't think will do as well is a lot of these companies that there's one brand to dominate a market. For example, Heinz ketchup, right? There's one ketchup to dominate all ketchup. The mustard too, and the mayonnaise. Cereal really is a duopoly with Kellogg's and General Mills. By the way, millennials don't really eat cereal. You have to sit down and take your time to eat a bowl of cereal, and they're on the go. So I think those like Kraft, there's just one macaroni and cheese, and that just dominates. And what do millennials prefer? They'd prefer to go into a grocery store and have 20 different options of ketchup. And none of them's like this big, the dominating brand. And if you go into like a Ralph's versus a Barron's, Ralph's is the home of all those big brands. And then you go into Barron's and there's hardly any of those big brands in there. All these off brands, and 20 different types of macaronis, and 20 different mayonnaises, and so how do you pick that? Those other big companies, how did they dominate? Through advertising, right? Because it's a national brand. You have national advertising on national TV shows and stuff like that. But how would these other companies market if they have really good Yelp reviews? So a millennial will go into the grocery store and Yelp review these 20 different mayonnaises, and that's how they're going to decide which one they want. So that national advertising is giving way to more targeted advertising. And so what does that mean for the stock market? Because, I'd rather invest in a company that was national and that dominated its space and could be $1 billion company, right? What if mayonnaise goes from being whatever, a $10 billion industry to still and one big leader to a $10 billion industry with 20 companies that are all $500 million companies. So that changes the way we think about investing, because we maybe want to go more small cap or even private instead of the public market. So in 2022 we want to have more exposure to the private markets, because I think there's exciting things going on there. Companies that are going to go from 10 million market cap to 100 million market cap or something like that, or $1 billion, versus these $100 billion companies. So we're positioning for that kind of thing, and how to continue to grow and protect your wealth in this changing investing environment. So be prepared for us to do some repositioning, and not only defensive to get through this year, but also thinking long-term offensive on where we want to be, and not just rely on, well, that's always worked. Well, it doesn't matter if it's always worked if it's not going to keep working. if there's a different audience, you know. And and actually, that's one reason why America has been such a, a good place to invest, because this is how American companies think. We want to be the one company to dominate an industry, like McDonald's, for example, right? Sell our hamburgers around the world, even if they're not the best hamburger, but they're the best at globalization, right? And that's what America's been really good at. And it's just a way that Americans think. Like in Europe, oh, like when I went to Ireland, the place I stayed, the hotel, was owned by, you know, one family, and the restaurants was owned by one family, and the gas station was owned by one. And when you go shopping, the clothing store was, you know, just like a family owned type of store, right? Whereas in America, what do? We stay at a Hilton, and we eat at an Applebee's, and we get our gas at an Arco, and we buy our clothes at a Macy's. All these big global national brands that advertise nationally and don't necessarily have the best, but they have, they're scalable, you know? And so the millennials aren't so much into that type of big global scalable brands. They like kind of like that European way where, you know, it's a mom and pop and it's real high quality and it's real intimate and that kind of thing. So we want to rethink that. And the other thing we're looking at is in that type of environment, there still will be some companies that will be a winner take all, because some industries just don't lend themselves to 20 different ketchups or 20 different Google searches, right? 20 different places where you go to search, you know, that lends itself to monopoly. The same way that your gas utilities and water utilities lend themselves to monopoly. You don't want to have to say, well, you know, there's 20 people that I could choose to pay my electric bill to, and there's, you know, 20 different options coming into my house, and I plug into one of them. It just doesn't make sense, right? It makes sense for it to be a monopoly. So there's some industries that just lend themselves to monopoly, and those are going to be the ones that we hold on to and that we really like. And I think about Home Depot, and I say, well, do we really need 20 different Home Depots? And I don't really think so. You know, that's a tough one to divide up. You know, the Ace Hardware store they have some success, but man, it's hard for them to compete against Home Depot. So that's what we're thinking about, and how we're going to, where we're going to allocate your money. We're thinking more about, smaller companies that don't necessarily have to dominate the entire market, but are doing exciting things and growing from a small base to a bigger base, and we could get a good return. And technology is just super exciting about what's happening in the tech space and the innovations. And I've said before, we really like those companies that don't sell a product. It's something that's downloadable, and it's so easy to scale, versus having to make a product that, you know, if you sell 1,000 of them and then business grows and now you have to sell 10,000 of them, you need to hire up and start a new factory and get more resources and all these things. Versus if you're a company like Zoom and you have 1,000 people on Zoom, you could very easily have 10,000 people download that thing, or 10 million or 100 million. and without having to build new factories or hire more people or buy more raw materials. So those companies have a competitive advantage, and we like those. So I think even in the type of market we're in, there's opportunities. There's great companies, but right now a lot of those great companies are overpriced. So we're not just going to buy a stock because it's a great company if it's um, ridiculously overpriced. I think that's the type of company that their valuations will get um, grinded down to, I don't know if you said, let's say ground down, um, to a more reasonable valuation, even though it's a great company. So um, that's our review of 2021. Our outlook for 2022 is caution, is kind of changing direction away from high growth to more defensive, and positioning the portfolio to emerge from this period of rising interest rates. Okay, so we'll definitely be communicating more on this, and we hope you guys have a fantastic New Year's.